It would be the same day I'd be meeting someone who's 18 years old, and at the same time, I may be meeting someone who's an absolute billionaire. I had 18 properties at that stage, and I had quite a bit of mortgage, but this was 16 years ago. So, no, I buy shares. And my father said, no, buy the property and it'll show you your magic, right? Tell us all this extra deduction.
Hi everyone, and welcome to another episode of Passive Income Doctor. Today we have a very special guest, Munzural Khan, accountant and founder of KHR Partners. Welcome to the show. Let's start. Can you tell us what you do kind of day to day, and what an average day looks like, if there's such thing as an average day?
What is an average day of an accountant? So Daniel, I'm an accountant, and I've been in the profession many years now, 28 years being in the profession, starting with a couple of a small practice, BDO, PwC, starting our own practice, KHR Partners, around 16 years ago. The previous structure was Kesha Proprietary Limited, expanded itself into KHR Partners. So what is my average day? I'm not a very early riser. I get up at about 6:30 and sometimes sleep in about 7ish or so. Leave home, say 7:30. I generally take a couple of phone calls when I'm on the car. Being in the office anywhere between 8 to 9 a.m., my day gets very interesting. And the reason I say I get very interesting, because I get a whole bunch of meetings throughout the whole day. And it would be the same day I'd be meeting someone who's 18 years old. And at the same time, I may be meeting someone who's an absolute billionaire. I'd be meeting someone who, let's say from a doctor's side of it, someone who's just starting. And I would be meeting someone who's got quite easily about 5-6 medical practices, 120 odd doctors that they're all working through. So each one of those meetings is I suppose the one we say challenge is that challenge is one is to be presence, but at the same time is to listen to each individual circumstances and how do we contribute into each one of those meetings. So my days are generally full of meetings. There are a number of internal meetings where we take actions in terms of what we do. I try to leave office about 7:30.
Wow.
And when I go home, I spend a bit of time with the kids. Our son is 21 years old. Our daughter is 17 years old. She's doing her HSC. So a little bit of time with the kids and a bit of time with Purabi. And Purabi and I, we've got a wonderful relationship. We're married for 25 years now. And when I go home, she's the one who speaks. I'm the listener. She's the one who gives the instruction. I'm the instruction taker. Yeah. And when she speaks, I can't have my laptop open. Laptop needs to be closed, need a full attention. And if you ask me about the Indian gossip in terms of the Indian Bollywood movies, you would be surprised to know how much I know about the Bollywood. So that's my evening.
And that's good. I think having a good home life and also having an outlet outside of work, I think for all busy professionals, doctors included, accountants included, I think that is very essential. So I guess what made you decide to, after working for, I think, PwC and other companies, what made you take the leap of faith and start your own business, and what's made you expand and want to do the KHI Partners?
Interesting how you ask, Daniel, because there was actually not a whole lot of a master plan. I was quite content in BDO, I was quite content in PwC. It was one of those year in PwC that we went through the GFC, and I was the group manager of PwC at that stage, and we went through various level of turmoil, which perhaps is all big fours that have went through in terms of retrenchments, in terms of various cost cutting and various matters. And that was the year that I sort of took a step back, and many of those cost cutting, I had to be involved. I was doing many of those cost cutting.
Right.
So that was the year that I took a bit of a step back, and I said that surely life has to be quite a bit more rather than just your funding and that sort of bottom line profit and always working in I suppose in a machine, right? So I said, it's the soul which is missing. And I suppose there was a moment where you have those moments. And one of my moments was I was speaking to the general manager of Christian Dior. And I used to look after the Christian Dior, Louis Vuitton, Fendi, many of those sister entities as being the external CFO. So as I was speaking to general manager, she called and I was like, how are you doing? And Jenny, how are you doing, Jenny? How's everything? How's your daughter doing? How's your husband? And how's everything? Jenny listened to me for good about 30 odd seconds. And Jenny says, Munzural, I'd love to tell you all the stories. How am I doing? How's my husband doing? How's my daughter doing? How's she going through with the HSC? I'd love to tell you every one of those. But on the back of my mind, I'm thinking, you're charging me $750 an hour. And there was a moment that I took back Daniel and sort of said, you know what? She's right. That is my hourly rate in PwC. And I said, surely there got to be a time and a space where we have the human connection. So there was a moment that I said, life has to be a bit more than just charging at $750 an hour. So I started my own practice. So when I started my own practice, I had no plan in terms of becoming anything big. My whole objective was to stay tiny little practice, stay as personal as we can, and stay connected to the clients. And before we knew is that we started to grow. And if I reflect back now, Daniel, after many years, that we've been so blessed in many, many different ways that we do various different level of services. I'm being surrounded by 25 plus partners, surrounded by 7 offices, 140 odd members. And if I look back and if I sort of say, what has really worked out when there was not a lot of master plan, and I say that fingers crossed, touch wood, is our whole ethos and our whole principle. I say that affectionately now is that very often when we work with our clients, we say, let's do a business plan before you go to the business, right? So you got to do your forward cash flow projection, your data analytics, your solvency ratios, your risk mitigation, cash in your hand, all of those things that we do. But I started my practice 16 years ago when we started with a value plan, an ethical plan as opposed to a business plan. And the reason I started this is that I said to myself, I'll give myself about a year or so, see whether it works. I had $100,000 savings on those days. Can you believe it? That's all I had. 100,000. I said, I'm going to survive on 100,000. I'll give it a go for 1 year. If it doesn't work, I'll go back to some other employment, but I will do it the way I really wish to do. And our entire ethical plan was a one-line plan, which we still nurture, still try to understand, go deeper and deeper. And wherever I get a chance, I share this. And that one-line ethical plan is the plan saying, contributing to your life. How do we contribute on each circumstances? How do we build a relationship? How do we help someone? How do we really listen to understand, not listen to respond? And how do we really listen to what your needs are, as opposed to give a preformed solution to it? And how do we really contribute? And our whole ethos is that if we can find a way to genuinely contribute, our business will look after itself. And I look back after that many years, we've been very, very, very blessed.
I think touching on, listening to understand, not just to respond, I think that hits home. And I think this is very important in any service industry, including accountant, including medicine. So thanks for that. I was just curious, when you started the business, I guess obviously adjusted for inflation, 100,000 back in the days more than today, but still, did you have a mortgage at the time or young kids at the time? I'm always interested in, I've interviewed a few other entrepreneurs on this show, and it's always interesting to hear the starting story.
I had 5 clients in day one, and my top line revenue in day one was projected revenue, yearly revenue was
15,000.
And the premise that I rented, the rent was 35,000. So I sort of say, I was starting with $35,000 rent. Forget about everything else. $35,000 rent with 15,000 as my top line revenue. I had 18 properties at that stage, and I had quite a bit of mortgage. But this was 16 years ago, so there was a bit of a cash flow, and I've sort of done the projection saying for 100,000, I can sort of survive for a year with a little bit of income or perhaps no income, as long as I can cover my rent of 35,000 in some shape or form. I probably would be able to cover it. And that's where we started, Daniel.
And was it because I know some commercial properties, they make you sign a longer lease, but they were happy with a 1-year lease? Or
no, in my case, a good question, actually. In my case, it was a 1-year lease. I have taken a 1-year lease with option at that stage of 3 option and 3 years option. And it was a tiny little place, right? Because I used to be in PwC in the 360-degree views of sort of the water views and sort of level 19 and all the rest of it. And I'm not prejudiced. I was being brought up in the Campbelltown area, so I
Yeah.
can't be prejudiced.
Yeah.
And I moved all the way from Sussex Street in Sydney to all the way back to Campbelltown with no window, 35 square meter place.
35 square meter.
And that is all I had. And I was like, that's a start.
And also, obviously, myself also property investor as well. At the time with your 18 properties, overall, were they slightly positive cash flow or were they quite negative cash flow? Or
it was not quite negative cash flow, but it was still a bit of a shortfall. Yeah, you get some tax benefits and you had some savings and so forth. Because see, many of my properties I bought it over the years, right? And so my first property, as an example, I bought it back in 1999. And I've invested every year since 2001 onward in some shape or form. And many of those properties, what it does is that even if you buy the property into the current market value as well as the rent at that point of time, the fact that you're playing with time as opposed to so much timing, right? You work with that longer period of time. What it does is that the rents increases and increases. If I look into my very first property, it's sort of sitting at 40% rental return of sort of the original purchase price, right? Now that sounds crazy, but it's actually nothing extraordinary property. It's just that I've been owning this property for
25 years. And I guess if you're happy to share, now I understand you've got a large, is it around 100 properties?
No, look, the number doesn't mean anything, right? Because in a way, number means nothing. Someone can have 70 properties, 100 properties, 40 properties, 200 properties, but what is the value of those properties, right? In a way, sort of this numbers, it's not so much the number of properties, it's about where overall your asset value is, overall your mortgages is, and more importantly, overall what's your net asset is. Yeah, someone may own 100 properties, 95% LVR, loan to valuation ratio. Someone may only own 2 properties, which is fully unencumbered. The person who's got 2 properties has got more wealth. So we've been very, very blessed, Daniel, that God has given us a lot of things. And we feel we're very blessed. And Pravi and I, Pravi is my wife, and we feel that financially, if we say that we wish to retire, God has given us enough that we can drop everything and we should be okay.
And financial freedom and having that options and security, I think, is something a lot of doctors are striving for. And thanks for sharing. And I guess then we can talk about maybe the start then. How did you get started with property investing? A lot of listeners curious or thinking about property investing, a lot of medical students or doctors in training.
Look, I mean, how we got started, right? Day one, back in 1999, it was early 20s. I had no intention of buying properties in the early 20s, right? My father wanted me to buy the property, and I had about $24,000 savings at that stage. And my father says, buy a property. And I said, no, I'll buy shares. And my father said, no, buy the property. And I was like, no, properties are boring. The tenants sort of breaks up some curtain and sort of blinds and carpet needs to be changed. Look at the share market. It's exciting. It goes up by 12%. Then it goes there. My father says, listen to me, my son. First property, buy the property. And after that, you do what you wish to. So I've listened to him. I didn't have a choice, but I listened to him at a stage. Yeah. And I still remember that I had a choice in between 2 properties. So there was one property. There's 2 sides of that story, and I want to share both. So I had a choice in between 2 properties. So I had almost a reasonably newish property in Ingleburn, 350 odd square meter land. And it was picture perfect inside. Land was small. It was a carport only there. And there was a tenant. So I had that choice 1. And then I had a choice 2 of a property which is just outside the Ingleburn station. And it had about 1,600 square meter land. And it had a broken down house. My father says, buy this one. I was like, no, you're crazy. I'm not going to buy this damn broken down house. I'm going to buy almost that brand new property. My father says, buy this one. You're buying it because of the land. You're buying it because of the location. You're buying it because of the future level of growth potential. And I said, no. Look at this property. It's shiny. My father says, you need to learn in the hard way. You buy this other property. So I bought this other property. And if you look back now, is that the property that I didn't buy, it's all being R4 zoning. And if you go around there, you've got lots of units in there.
Wow.
There's literally so many units in there on that one property. And that's the, I suppose, the learning experience that in the longer period of time, it's growth. But what is even the deeper learning experience is that even the property that I bought, which was, of course, it was not the best of those two choices, even that property, if I look through today, is that it has grown to about 5.5 times of the original purchase price. So what I take the lesson out of it is that arguably any action is better than no action. But in between any action, if we have a sophisticated action, learned action, and measured action, that is much better as opposed to an uneducated action.
And 5.5 times over 20 odd years. Yeah, well done. I guess shifting gears a bit, we'll talk about tax and doctors, and obviously we'll preface by nothing in this podcast is personalized financial or taxation advice. I guess what are some common mistakes that you see doctors and health professionals make in regards to, I guess, firstly, tax and tax affairs, and then secondly, with building wealth and wealth creation?
I think one of the fundamental is that in my mind, it's being hands-on as opposed to being hands-off, and having that right layer of balance. How do we being in between both? So I sort of consider that as a professional, let's say if I'm as an investor, purely as an investor, I need to know enough so I can ask the right question, but I don't necessarily need to know every single thing on every single field. And I think that's something which I say to the doctors, because the doctors are very intelligent, right? They're very intelligent, they're very capable, and they're very detailed. So they sort of almost go so much deeper into the tax legislation that sort of rather than becoming productive, whether it becomes, I suppose, overly analytical. So that's probably one comment that I would say that action taking is comment number one that I would take. Second comment that I would say from the doctor's perspective is that looking into the bigger picture. We all have a bit of budget. We all become a bit of a cost conscious, but it's sort of more sort of concentrating where the value is and not so much just the cost consciousness side of it. A second point that I would say. Third comment that I would sort of say is that start with a very long-term feature. Yeah. That is, where do I see myself into 15 years time? Where do I see myself into 10 years time and 5 years time, and plan accordingly as such? Not so much a step-by-step plan, right? How do we buy the next property, right? So you almost visualize how you get there. Now, the other sort of the tip from the doctor's perspective is that ideally go with a group of people or create a group of people where you've got the right team. And that right team means that you've got a specialist in all around you. So in my case, as an example, let's say finance. Finance is absolutely fundamental. I would have enough experience that I can ask the right question in the finance, but I surround myself who specializes on the finance. So I can ask the question, but they can actually go up there a lot deeper and go into the solution a lot deeper. So that's probably the next comment that I would say. And the subsequent comment that I would say with the wealth creation, with the doctor side of it. And you know what, for any profession, yeah, I'm a big fan, Daniel, in terms of consistency and persistency. It's not so much we need to win the entire world in one day. We sort of do some steps, but we do some steps every day. And that every day is the one which is that trick behind it. So when you sort of say, Munzural, your property that you're saying it's becoming 5.5%, maybe even close to 6 times of your original purchase, but it's a very ordinary property. It's a very ordinary in the sense that it's a pretty mom and dad sort of a property as such. But all it had going for it is the time. And because of the action that I've taken, I kept it over a longer period of time. I stayed persistent and consistent in terms of keeping this, as well as purchasing other properties along the way. All those small, ordinary steps, a combination of it becomes very extraordinary. So it's that longer term vision. It's that relationship based with the team. It's about knowing enough so you can ask the right question, then leaving it to the expert. It's about concentrating on the values, all of the above, and perhaps much more.
Thanks for sharing. And I think consistency is one trait which I think a lot of top performers have, in any field. And that's a reminder, whether for our career and also for our asset accumulation investing as well. One point where you talked on where you said you might have seen some doctors or other clients fall down on in terms of value first cost. can you give any examples or any kind of common traits where, or even a story? I guess a lot of listeners resonate with stories where maybe someone just considered the cost and then didn't consider the value and ended in a bad outcome.
I turn around the other way around, yeah? And I sort of raise this comment very often is that do you need a specialist on the medical field or do you need a generalist? Now, if you need a specialist, the specialist is not going to be available next day. It takes time to make an appointment with the specialist. And a specialist is a lot more expensive. Specialists may not be immediately available on the phone. You get all of those constraints. However, once you go to the specialist and once you are on the limb to the specialist takes full responsibility of your entire well-being over a period of time. That's the professionalism is being learned, right? So fundamentally is to find who is the accounting and who is sort of more data entry. So what is your compliance accountant and what is your strategic accountant, right?
Right.
So from my point of view, as an example, is that when I go to a specialist, I don't want to create the guideline that you as a specialist that perhaps this medication would be better for me or that medication would be better. I can't do that. I don't have the knowledge, right? All I give is to give my symptoms. And I sort of say, that's how I feel. That's where I'm at. And the specialist is the one who gives me that medication side of it. And I rely on that medication. Of course, I keep the specialist accountable. If the medication doesn't work, I communicate to the specialist. If there is a different layer of support that I need to get and I'm not getting it, I communicate. So I think the truism in terms of the cost and the value side of it is that how do you build a sustaining relationship? In our practice, Daniel, as an example, any doctor who comes in, we've got a criteria. We sort of say, how do we service you, Daniel, for 30 years? And as soon as we sort of have our own mindset is to say, how do we look after Daniel or any doctor for 30 years? Then we start thinking, how do we provide value in the longer period of time? And we sort of say, the short-term sort of fee cost, we let them go. That's the relationship that we are after, as opposed to just that immediate cost, what it does. Cost needs to be fair. So it cannot be an exuberant cost. I agree with that. It needs to be fair, but as long as it is reasonably fair, it's the value that we are after.
And can you share any case studies, and it could be de-identified, in terms of some success stories, in terms of maybe, because you've been practicing for a while, maybe a doctor who you worked with initially early in the journey and where they are at now? Hopefully it'll be some sort of, inspiration or some lessons for our audience who is younger.
Absolutely. So I had this, so many stories, Daniel, right? Like one story as an example, I had this specialist anesthetic, and the gentleman came in years and years and years, is that he had his principal place of residence being fully paid. And he's got one additional property that he goes there as a bit of a holiday home that's also being fully paid. And then he's got a whole bunch of cash. They're all sort of sitting around everywhere in a whole bunch of cash. He's got a bit of in his shares and managed funds, but he's not really their shares and managed funds. And then he's got a whole bunch of funding into his industry fund as well. And his income is very strong. Of course, he's at the highest marginal rate, but some significant amount of tax that he pays. So he comes over saying that, what do I do? What is my deduction? What are the extra deduction that I can claim? Come and show your magic, right? Tell us all those extra deduction. And I was like, I'm sorry, there's not much more extra deduction, right? Because we got to be within the rule. And what the ATO rule says is that these are the deduction that you are allowed to claim. And you know what? Your previous accountant has done well. I've claimed all of those. There's no more deduction to claim. And the gentleman says, well, what is the value then from you? And I said, what the value is that how do we consider on a macro level as opposed to a micro level? So if you're with an accountant, he or she is concentrating in terms of how much we can claim as a tax deduction, it's limited. The question is that how do we go into a wealth creation journey? And without giving any financial planning advice, I can't. How do we go into a wealth creation journey where naturally you get a whole bunch of tax deductions as such? So this is where you are creating wealth. That is your primary objective. But under the rule, there are significant level of deductions that you can claim. So the gentleman went into a journey on his own. We haven't given him the journey. We only challenge him We
Mm.
sort of explore with him factually what are the different options and what are the pros and cons. He's the one who makes the decision, right? So he went ahead, who bought a whole bunch of properties on his own name. He created a trust. He bought few properties into the trust. He went into the journey of the superannuation fund. He also purchased a couple of properties on the super fund to have the diversification. This particular gentleman has quite a bit of shares and ETF in his superannuation fund. He also has some ETF on his family trust as well. Then what we did is that we looked into his insurance. We made sure that he's got the right level of life insurance, TPDs, income protection, all of those insurances being covered. This gentleman that we recently working through with him on the estate planning to have your testamentary trust, power of attorney, enduring guardianship, wills, all of those, and financial binding agreement, all of those different things that we worked through with himself. So everything is there we worked through. So I look back to this gentleman now and I say that 3 to 4 years ago, this gentleman was here. He had all the income, all of those cash in here, whereas he's now in here where his wealth is so much higher. One is that he bought it well with different level of buyers agencies that he utilized. He bought it well. And number two is that some of those properties have increased in value since then. His tax position is much better. And he looks back into his wealth and he sort of said, good Lord, I've got all of those growing assets. I've got diversification into my asset base, and I've got liquidity into my asset base. I've got my insurance is being covered. I've got my estate planning is being covered. So he sort of considers that he's got a well-rounded support as opposed to just an accountant who is trying to save, I suppose, cents and penny on the tax. So I look back to this gentleman and I say that, and that's what we take with a lot of gratitude in terms of success.
So how old was the anaesthetist when you first approached it? Was he in the early 30s or was he later in his career?
No. This gentleman is late
Okay,
40s.
just some context.
40s, right? And significant income, right? Absolutely significant level of income and very well established in many different ways. But a typical specialist that all income under the PSI, personal service income, everything goes back to individual name. It doesn't have a lot of a space to move in terms of the tax planning side of it, right?
Yeah.
Any of those to structure him out of it are outside the law.
Yep.
But what he can do is that he can buy multiple properties. We looked into risk management as an example. That the question was that, well, do we need to go all the way to 95% without LMI as the doctors are allowed to? Because the gentleman looked into it saying that, look, I probably don't want to go. I'm happy to stay with 80%, even though I can go a lot higher. He had the equity for him to be able to do this. So risk is being managed. And then we also looked into it saying that, well, specialists do have some practice risks, and some of those things we managed as well.
So I guess then from what you said, improvement in tax position over the last 4 years, maybe in terms of negative gearing from the properties and...
That's right. And remembering this is important point, right? We don't buy the properties because of negative gearing. The properties the gentleman has bought on his own was more in terms of growth-oriented properties. And these are the properties which are growth-wise significant growth prospect, and they've done well, and they will continue doing well. But on the other side of the equation is that because they're growth-oriented property, they're a lot more land-heavy. Means that the rental income is slightly lower, means that naturally your cash flow is lower. And while your cash flow is lower, there are some tax benefit. But it's the tax benefit we're coming in as a byproduct, so to speak.
And is there now a talk or strategy of thinking of towards more income focus like ETFs or commercial property, or is he still in his accumulation phase? Or...
He's sort of still in that accumulation phase in the sense that if the gentleman wishes to, is that he can retire at a point of time. Generally, what we do is that when we look into the retirement planning side of it, we've got a financial planner who does the retirement planning. We sort of say that give us about a couple of years or so we can advance to start planning in terms of how to do it. This the financial planner sort of gets involved. So he sort of feels that he's got a few more years that he wants to run around and do a whole lot of things. Not so much he needs the funding as such. He loves what he does, right? But what we have very strongly started to speaking to this gentleman is that how do we assist to the next generation? So he's got his kids, right? And how do we assist kids with some level of parental guarantee as an example? And how do we get the will right so that as a succession plan is that when he wants to hand over those assets to the next generation, some of those assets, it gets transferred in the right way so the tax is being managed at that level. So this is a right example where someone started as a very simple and has grown all this layer of wealth And we now speaking, not so much we actively speaking, but we're discussing that there would be a point of time with retirement, there would be a point of time with the estate planning, and there would be a point of time with the succession planning.
Mm. And I guess talking to you, Munzural, I can see that the benefit of you having partners in KHI, partners, as you said, such as financial planners and mortgage brokers, etc. I guess now also running, a large successful business. Any tips for entrepreneurs and business owners out there in terms of when starting from one or solo towards a small team, towards a larger team? I'm sure there would have been challenges along the way. Any kind of words of advice? And I guess hiring and firing, I hear from entrepreneurs, is difficult, but also a very important aspect. Do you have any kind of words of wisdom you wanted to share?
Go with the values, go with the ethics, go with the principle, go with trying to really contribute to everyone. Rather than trying to win the next dollar and the cents and penny, say that how do I help out everyone? Australia is a beautiful country. More you help, more you get it back in many, many times. We never ever worried in terms of the funding side of it from our point of view. Always sort of said, how do we help you? And as soon as we do that, is that there is a fantastic sort of, whether it's karma, whether it's the universe giving it back, whether it's Australia giving it back, is that it all comes back. Stay with the values. Not to compete yourself between you to someone else. Compete with yourself. How do you as an individual continuously grow more skills over a period of time? How do you stay accountable to those truth and that value side of it? How do you stay resourceful where you solve problem for everyone, right? Or to the best of your abilities. That's the entrepreneurship side of it. Empathy, humanity, kindness. These are all strengths and none of these things are weakness. And nurture them on an ongoing basis. As a property investor, a fundamental of it is again going back to it, persistency. If I buy one property per year, and if I do it for a very long period of time, good Lord, it does it very well. Action taking in a consistent basis.
Thank you for sharing that. I guess one topic which we touched on and maybe we might need another podcast to talk about is the PSI. There's lots of other topics such as negative gearing, debt recycling, which we touched on briefly as well. With PSI, you always see on the forums, a lot of doctors try to ask questions, hey, if I set up a company, or is there ways around it? Do you have any kind of guiding principles that you would say about doctors and PSI? And is that also maybe why some doctors would then transition to being GP clinic owners or owners of other businesses to try and become a business rather than a sole trader PSI?
The personal service income and the PSI and we can move into the PSB, personal service business, is sort of effectively means that if a doctor is earning all of his or her revenue from his or her personal exertion, is that everything is subject to be taxed on the individual rate. And that is sort of how it is. Now, if it's being done through a corporate entity, all profit needs to be distributed back to the doctor. If it's being done through a trust, everything needs to be distributed to the doctor. So I suppose the first comment which I say is that absolutely brutally stay within the rule, i.e. is that not to try to create some structure to get oneself out of it. One is that it doesn't work. Number two, of course, it's illegal. And under the Part 4A, which is the anti-avoidance as such, right? So stay within the rule. And the rule says that if you are earning all of those on a personal exertion, that unfortunately it becomes subject to tax to yourself. Now, that's why the doctor sort of says, well, how do I get myself out of it, right? If you're genuinely in a business, then you are genuinely in a business, but you've got a whole bunch of criteria that you need to fulfill, right? And I think rather than trying to bend the rule, is that what I'm more interested in? And we never bend the rule, right? I'm sort of more curious to sort of say, how do we do what that other doctor did? Is that example that we've given is that we grow wealth, and through that wealth, we get some tax benefits along the way. Yeah.
Yeah.
And the next comment, which I would say, is that work it through with your accountant in detail. Ask that question that anything which I'm doing, is it audit proof? If it's not an audit proof, don't do it.
Thank you very much for coming onto the show, Munzural, and sharing your wisdom about property investing, about business, and also sharing your life as well. Any closing thoughts of advice for our doctors, listeners out there?
Keep learning, And I love listening to the podcast on an ongoing basis. I listen to all the different audiobooks. I read it to as much as I can. Keep learning, always stay inquisitive. But at the end, it's the action taking which gives us the implementation. So have fun on the journey. Take it seriously, but at the same time, not to take it too seriously. Stay kind to everyone else. Stay kind to all the service providers, and you would see the result comes in multiple ways.
Yep.
And have fun.
And finally, how can people learn more about you and KHI Partners? How can they reach out?
Thank you very much. So directly to our website, khpartners.com, and to me personally, Munzural.Khan at khpartners.com.au, or maybe admin at khpartners.
Thank you for coming onto the show. And to all our listeners, thanks again for tuning in and listening to another episode of Passive Income Doctor. See you on the next one.